You know him as a guest judge on ETF battles, but did you know that he's also an author? We're pleased to have with us Dave Kreinces, the Chief Investment Officer and founder at ETF Portfolio Management. His latest book is titled Investable Benchmarks, a guide to ETFs, technology, and leverage. Dave, it's always great to see you, and congrats on the new book.
Thank you. Thank you. Much appreciated.
So let's begin with the first question, Investable Benchmarks. This book covers a lot of ground about how to build and manage a portfolio of investments in all kinds of market climates, good, bad, everything in between. So why did you write this book, and who is it for?
The Investable Benchmarks book is really for everyone to see the most important investment trends and ETF portfolio management techniques. Investors should be thrilled to learn that they can outperform with just two leading ETFs. And once I saw that strategic diversification could be a free retirement nest egg, I wanted to share it with people. And clearly there are risks, especially when using leverage, and performance can never be guaranteed. But investors should see that these new ETFs and the investable benchmarks are revolutionary when used properly.
Now, chapter 3 of your book talks about strategic diversification, which is a heck of a lot better than generic off-the-shelf diversification, which is what millions of people are force-fed through their 401k plans via target date funds and other third-rate devices. So can you give us an example of what you mean by strategic diversification?
Well, strategic diversification has changed over time, and the most innovative application today has proven that investors have been better off owning more of a safer portfolio instead of having less of a risky portfolio. So in the old days, you used to take more risk to get more return. Now that we have leveraged ETFs, we can simply own a safer portfolio and have more of it. And when you see the return improvements in the investable benchmarks, which over the past 10 years have amplified returns by as much as 2 to 10 times, it is really exciting for investors to see that even this year, in a crash with the S&P down 10% or a little more, the investable benchmarks are up 6 to 24% year to date passively. So it's really exciting to see that investors can generate more return safer than ever before.
Can you just explain to our audience, you keep talking about investable benchmarks. Really, these are made up of ETFs. Just go a little bit into more detail about what the investable benchmarks are that you created.
Well, the investable benchmarks were designed to give investors an efficient, easy solution that most investors simply can't beat. So we created sample portfolios for the 4 main investor risk levels: small, medium, large, and extra large. And it's really incredible to see that when you use a balanced portfolio and you're sticking with long-term treasury bonds on the bond side, which has given you the best protection repeatedly, you can use moderate leverage with discipline. And when you see the power of leverage and the power of the balance to reduce your risk and increase your return, investors have a lot to get excited about.
Now, some investment managers, as you know, are very leery of using leveraged ETFs. On the other hand, as you just alluded to, your firm is quite comfortable and actually embraces leveraged ETFs. So how have you been able to successfully deploy leveraged ETFs in your practice?
Well, it's understandable that many firms and advisors would resist this new innovation. These levered ETFs are complex products. Some of them don't work very well. And even the best of them can generate distorted returns that are hard for investors to understand. But again, when they're used properly, the way we show them in the investable benchmarks, investors can employ them slowly and carefully. And when you look at how much leverage investors put on their homes, on our real estate, when we buy a home with 20% down, you put that, you get an 80% mortgage on a house, you're using 5 times leverage on a residential real estate. And retirees who have no leverage on their retirement nest egg and have leverage on their homes might look at the long-term returns and the liquidity and the tax impact and the transaction costs and eventually realize that they're putting leverage on the wrong asset class. Now, if you have to, you have to. And if you need it to be in the home you want, you do it. But when you look at leverage on an asset class, the diversified portfolio has been more productive in recent decades than real estate.
Investors, as you know, are often their own worst enemies. They do the wrong things at the wrong time. In these crazy times that we've been in, we've seen a lot of volatility, obviously, in stocks and other asset classes. Any words of advice that you can offer our audience and those who are maybe a little bit on the skittish side?
Our thoughts go out to everyone who's been impacted by this situation. And the real way that investors have protected themselves in the past has been to use long-term treasury bonds for protection, stay balanced, and recognize that it's okay to raise cash. You can reduce your exposure to risk assets, especially in a pandemic, and you can gradually reinvest as the markets stabilize. So investors need to remember that when you stay balanced and you stick with long-term treasuries, the volatility is much lower in general. And then if you're still uncomfortable, you can gradually raise cash if needed. Just be disciplined on your reentry.
One final thing before you take off. The Federal Reserve, as you know, is now into the bond market like never before. I mean, they're buying bond ETFs of investment grade quality. I mean, what do you think that this means for ETFs in general, the bond market? I mean, does the Fed begin buying equity ETFs at some point in the future and pull a Bank of Japan? How do you see it?
It's in discussions, and the market likes to remember not to fight the Fed. So the market, the S&P had a 35% bounce off of the bottom, and most of that bounce is still holding. So there's a lot of reasons for investors to be mindful that the bottom could be behind us, and the amount of liquidity put into the system and the growth potential for technology and artificial intelligence could lead the market to continue to disconnect from Main Street. And even though the psychology of most investors is far less stable than the strength of the S&P 500, investors should remember that the market is a machine. It's unemotional. And when the market has more technology and less labor costs and less power costs, both of which technology enable, valuations can go higher, multiples can go higher. And sometimes, like in 2019, that could even happen without material revenue or profit growth. So investors have to realize that the price trend of the market can be shocking at times. And we mentioned that in the Investable Benchmarks book, that the market can be irrational longer than you could be solvent, per John Maynard Keynes. And investors have to expect the unexpected. So if this market is trading at new highs before you expect, be careful fighting it, because there's a lot of technology growth, and the financial markets can be very disconnected from Main Street at times.
Well, Dave, thanks for your insights and stopping by. And again, congrats on the new book. Check out his 5-star reader-rated book titled Investable Benchmarks, A Guide to ETFs, Technology, and Leverage. It's available at Amazon.com. I'm Ron DeLegge with ETF Guide TV. Thanks for watching.